we do need to talk about basis. So there are two types of basis. There's the basis of the ownership in the company by an individual, and then there's the basis of the assets of the corporation. So when a C or S corporation is formed, individuals will purchase or otherwise acquire stock. So with partnerships, we didn't have stock, right? We just had a ownership percentage. With a corporation, though, you're buying stock. Okay, so you're buying shares in that corporation. The stock is an exchange of cash or property for stock. So I pay $1,000 and in exchange, I get 5 shares of, I don't know, what's $200 a share? Roughly. Palantir. I'd probably get more than that with Palantir right now. But so I'm exchanging cash, and in exchange, I'm getting stock. And what I anticipate is that the value of that stock is going to go up. So yes, I'm giving up $1,000, but my thought is that that stock is going to be worth more at some point in the future. So this is an investment for me. If the transfers control 80% or more of the corporation immediately after the exchange, generally speaking, the exchange is tax-free. So as long as the shareholders control 80% or more of the corporation. So here's an example. We've got Marty and Sarah. They're forming a company, Boone Company. Marty is transferring $1,000 of cash in exchange for 100 shares of stock. So he's giving the corporation $1,000, and in exchange, he's getting 100 shares of stock. This really isn't how it works, like when you think of the stock exchanges that we're familiar with, like the New York Stock Exchange and the Dow or the S&P, all of those different markets. What those are third-party markets, so that you're not buying it directly from the company, you're buying it from somebody else who owns the stock. But in these scenarios, it's where you're buying it directly from the company. So Marty transfers $1,000 cash in exchange for 100 shares of stock. So $10 a share is what the cost that he's paying for that. Sarah is transferring a bond with a fair market value of $1,000, but the basis to her is $800. She's also getting 1,000 shares. So she's getting the same amount because the fair market value is the same as what Marty's fair market value is. Her basis in that stock, though, is going to be $800. Okay, even though it's worth right now $1,000, if she were to go and sell it, she'd get $1,000. She'd have a $200 gain, though, because the basis of what she's giving up was $800. Because they control 80% or more immediately after the exchange, that transaction is tax-free to them at that point. There are 2 cases in which a taxpayer may have to recognize gain, though, even if that 80% rule is met. The first, when the individual transfers property that has a liability attached to it. So some sort of loan that's attached to it. This was just like the partnerships, right? When we transferred it in, if there was a liability attached, and if that liability was more than the basis of the asset, then there was a gain that had to be recognized. So when the individual transfers property subject to a liability and the relief of the liability is greater than the basis in the property, then the gain is equal to the excess of the liability over the basis. So same as with partnerships. Same thing that we discussed in the last chapter. Here's an example. We've got Gina. So Gina is transferring an apartment building to GGG Company in exchange for all of the stock in the company. So she's going to own 100% of that stock in the company. The building has a basis of $100,000, a fair market value of $500,000. So obviously it's worth more than what her basis is in the building, quite a bit more. It also has debt of $300,000. So there's a loan against the building of $300,000. Makes sense, right? She probably refinanced it, or she has depreciated it over the years, and that's why it has a basis of $100,000. Even though she controls 80% of the company, more than 80% of the company, after the exchange, the transaction is taxable because she's being relieved of that liability. She's being relieved of the debt. And the amount of the gain she's going to have to recognize is $200,000, which is the $300,000 loan amount, liability, minus her basis. Now she's got a gain because she's being relieved of that. She's now economically better off because she doesn't have to pay the loan on that building. So that's one way that you may have to recognize gain. The second way is when an individual will contribute cash or other property, and in exchange, in addition to stock, they also get something else back, usually in the form of cash. So you get stock plus cash or other property. So I'm giving a building to the company and I'm getting 1,000 shares of stock, but in addition to the 1,000 shares of stock, they're also paying me $10,000. Okay, so that's where the person purchasing the stock is getting something in addition to the stock. They call that boot. So whenever there's boot, the taxable gain is the lower of the fair market value of the property received. So in my case, they gave me $10,000. That's $10,000 fair market value. Or the realized gain, which is the fair market value of the property contributed less the tax basis of the property contributed. So the gain that would have been recognized if they just out and out sold it. So an example of that, we've got Ernie. Ernie's getting the stock of EBU company. In exchange, he is contributing a machine with a basis of $15,000 and a fair market value of $25,000. So here, the fair market value contributed minus the tax basis. So the fair market value here is 25. The basis is 15, so he's got an unrealized gain of $10,000 on that piece of equipment. He also receives $3,000 of cash. He gets the cash from the company in exchange for, he's getting stock, but he's also getting $3,000 of cash. The gain on transfer is $10,000. So he's getting, which is the difference, like I said, between the fair market value and the basis. The gain that he has to report is $3,000 because it's the lesser of the two. So, like I said, the taxable gain is the lower of the fair market value of the property received. In this case, it was $3,000, or the unrealized gain, or the suspended gain that they had of the fair market value over the tax basis, what they would receive if they just sold it. So if he sold that piece of equipment, he'd have to recognize a $10,000 gain and pay tax on it. But he's contributing it instead, but because he's getting $3,000 back, that's less than the $10,000 suspended gain there. The basis of the cash or property received is equal to the basis in the hands of the shareholder plus any gain that was recognized by the shareholder. So the basis in the stock of the hands of the shareholder is equal to the basis of the property contributed plus any gain recognized minus any boot that was received, which would include the relief of a liability. So here's what it would look like for each of those scenarios. So Marty, if you recall, Marty contributed $1,000, and in exchange, he got 100 shares of stock. So his basis in that stock is $1,000, right? And now the company's basis in that cash is $1,000 as well. Sarah, remember, contributed a bond that had a basis of $800, but a fair market value of $1,000. Her basis in that stock, she got 100 shares of stock. Her basis is $800, which was the basis to her. The basis transfers over to the corporation as well of $800. Gina, remember, she contributed the building, but the building, she had to recognize $200,000 of gain on that building because she was relieved of the liability for that building. So Gina, her gain is going to be $200,000, but she has no basis in her portion of that company because the basis of that building was was what, $100,000. It was less, but that gain absorbs the rest of it. The property basis to the corporation, though, is $300,000, which was, let me remind myself here, the relief of the debt of $300,000. So that becomes, because now they're on the hook for that $300,000. And then we've got Ernie. He's got to report that $3,000 gain. His basis carries over. Remember, the basis here was $15,000, carries over to him, $15,000. The basis to the corporation is going to be the $15,000 plus the $3,000. So this one, let's see. So Gina's is a little bit more complex. Remember, it's going to be basis in stock in the hands of shareholders. Basis of the cash or property received equal to the basis in the hands of the shareholder plus any gain recognized by the shareholder. So her basis was $100,000 plus the $200,000 gain that she had to recognize is going to be, that's why that's going to be $300,000. Let's see, basis of the stock in the hands of the shareholder is equal to the basis of the property contributed. So she contributed $100,000 plus any gain she recognized. She recognized $200,000 of gain minus the boot received. Her boot received was $300,000 because she got a $300,000 relief of that liability. So 100 plus 200 minus 300. So that's why she has a zero basis here. Shareholders do not recognize any losses as a result of a formation when the 80% test is met. Providing services in exchange for stock, the individual will have to recognize ordinary income equal to the fair market value. So just like with the partnership, equal to the fair market value of the services. Unless a C corporation stockholder increases or decreases their ownership, buys or sells additional stock, there's generally no adjustment to the basis over time. So like with our partnerships, we were increasing our basis for income from the partnership, decreasing it for expenses from the partnership. It was constantly changing. That does not happen with corporations. Corporations are generally easier from a tax perspective than partnerships are. But what happens with corporations, it doesn't change unless you buy more stock or contribute more property in exchange for stock and that sort of thing. So you have to actually have some sort of external transaction there. Chapter S corporations, though, are different. They act like partnerships in this respect, in the respect of that basis is constantly changing, because S corporations are also a flow-through entity, just like partnerships are. Okay. All right. Basis. That's